Most people think investing is complicated. They think you need a finance degree, a stockbroker, or a lot of money to get started. But here's the truth. The basics of investing are simple, and the earlier you start, the more time your money has to work for you. In this video, we're going to break down everything a beginner needs to know about investing, from what it actually is to where to put your first dollar. No jargon, no fluff, just clear, practical information. Let's get into it. What is investing? At its most basic level, investing means putting your money somewhere so it can grow over time. When you leave money sitting in a savings account, it earns very little. Inflation, which is the rising cost of goods and services, steadily reduces your purchasing power. If your money isn't growing faster than inflation, you're actually losing value over time. Investing is how you beat inflation. It's how you turn a small amount of money today into something much larger in the future. Historically, the stock market has returned about 10% per year over the long term. Even after inflation, that's still significant growth. That's the power of investing, and you don't need to be rich to start. The number one concept: compound interest. The most important concept in all of investing is compound interest. Here's how it works. Let's say you invest $1,000 and it earns 10% in 1 year. You now have $1,100. The next year, that entire amount earns 10%. Then the gains from that year earn gains of their own. Your money starts working for itself. Starting with just $1,000 and never adding another dollar, decades of compounding can turn that investment into many times its original value. Now imagine contributing money consistently every month. This is why starting early matters more than starting with a large amount. Time is your biggest advantage as an investor. Types of investments. Now let's talk about the main types of investments you'll hear about. Stocks. When you buy a stock, you're buying a small piece of ownership in a company. If the company grows and becomes more valuable, your investment can increase in value. If the company struggles, your investment can decrease. Stocks have historically delivered the best long-term returns, but they can be volatile in the short term. Bonds. A bond is essentially a loan you give to a government or corporation. In return, they pay you interest and eventually return your money. Bonds are generally considered safer than stocks, but they usually provide lower returns. Index funds and ETFs. These are often considered the most beginner-friendly investments available. Instead of buying shares in a single company, an index fund allows you to invest in hundreds of companies at once. This spreads out your risk and provides instant diversification. Many professional investors recommend low-cost index funds because they are simple, diversified, and effective over the long term. Real estate. Another popular investment is real estate, whether through rental properties or real estate investment trusts. Where to invest? Accounts explained. Understanding what to invest in is only part of the equation. You also need to know where to invest. 401k. If your employer offers a 401k, that's often a great place to start, especially if they provide matching contributions. Roth IRA. A Roth IRA is another powerful option. You contribute money you've already paid taxes on, but future growth and qualified withdrawals can be tax-free. Brokerage account. A standard brokerage account offers flexibility and no contribution limits, although it doesn't provide the same tax advantages as retirement accounts. How to actually get started. So how do you actually get started? Step 1. Open an investment account. Open an investment account with a reputable brokerage. Step 2. Fund the account. Fund the account with whatever amount you can comfortably invest. Step 3. Research diversified index funds. Consider researching broadly diversified index funds. Step 4. Set up automatic contributions. One of the most effective investing habits is consistency. By investing regularly, regardless of market conditions, you remove emotion from the process and build wealth over time. This approach is known as dollar-cost averaging. Common mistakes to avoid. Before we wrap up, let's cover a few common mistakes. Mistake 1. Waiting for the perfect time. The reality is that nobody can consistently predict the market. Starting sooner is usually better than waiting for the perfect moment. Mistake 2. Panic selling. During market downturns, market declines are normal. Historically, markets have recovered from every major downturn and gone on to reach new highs. Mistake 3. Trying to pick winning stocks. Even professional fund managers often struggle to outperform the market over long periods. That's one reason index funds remain such a popular choice. Mistake 4. Investing money. You'll need soon. Before investing, build an emergency fund that can cover several months of living expenses. Investing doesn't have to be complicated. At its core, it comes down to this. Start early, invest consistently, keep costs low, and don't panic when markets fluctuate. Even small amounts invested regularly over a long period can grow into meaningful wealth. The most important step is simply getting started. If you found this helpful, don't forget to like the video and subscribe for more content on money, investing, and financial freedom. And let me know in the comments, what's your biggest question about investing? See you in the next one.